as you said, I'm here with Joe Baratta, global head of PE at Blackstone. So, Joe, we woke up this morning to all these headlines coming out of Vietnam, out of Washington, out of London. How is there so much optimism here, then, given what's going on in the world? Because this place is buzzing.
Yeah. Well, I think there's always a lot of noise out there, and our job is to think long-term, buying a good business, holding it through a cycle. Can we make adequate money? Can we do something to the business to improve it? And we tend not to focus too much on the short-term noise and what's going on in the geopolitical sphere.
So you've been meeting with a lot of investors here. 2,500 people gather here in Berlin just about every year, meeting after meeting after meeting with your limited partners, the biggest investors in the world. What are they saying to you? What's their biggest concern right now as they continue to give you more and more money?
I think people are really focused on where we are in the economic cycle, how close are we to a recession, our views on the valuation and capital market cycle. Valuations have been elevated for a while. But it's mostly about the economy, what could change it, what could lead to a recession, particularly in the United States, which is really driving the global economy.
And what's your answer to that? What do you think about recession?
As we look at our portfolio, there are small pockets of weakness, maybe the auto build in Europe and China and at some point in the US. Housing strong, employment strong, consumer spending seems to be strong. There's certainly a deceleration in the top line growth in some of our companies, and you're seeing in the overall market, but we're not seeing the signs, the telltale signs of a recession in the near term.
So Europe is especially interesting, obviously, to people here, but also to you. You sort of made your bones in a lot of ways in London. You ran Europe for Blackstone, did some of the seminal deals for Blackstone, Legoland, Madame Tussauds, putting it all together. Merlin Entertainment, I believe, was that deal. You were intimately knowledgeable about that market. Brexit, obviously high on the mind of folks there. How do you look at Europe right now?
I mean, Europe, I think, the recovery of Europe has been a bit of a disappointment in terms of the amount of economic growth. Brexit was unforeseen and is an issue. I think as you look at the UK, you want to price things with a little more margin for error. We're investing in the UK. We think it's a great economy. But there's some unpredictability, so maybe you're going to pay a lower price than you would have in a pre-Brexit world for some more margin for error. For us, Europe is a selective market. We have to find a company that we really think we can do something fundamentally to transform it. Growth is going to be harder to come by in the European economies than in the US.
So 4 years ago, I was going back and I saw that you name-checked Warren Buffett on the stage here, and you talked about long-term capital. Yeah. How is that process going of sort of raising money that you hold for longer and still are able to deliver the returns that your investors expect?
Well, we began the discussion with our investors about 6 years ago about a different structure to hold a certain kind of asset. Every other asset class, credit, real estate, has multiple structures to own different kind of assets. Safer assets are afforded a lower cost of capital. Private equity had one structure. You hold assets for 3 to 5 years, you hope to generate 20+% returns. And so we created a vehicle and we raised about $5 billion 3 years ago to buy really high quality companies with high predictability and hold them for a decade plus. And it's gone really well. We've made 3 investments. We're about to make our 4th. And I'm sure we'll be back out with another vehicle.
You talked a little bit about valuations in Europe. Take us back to the United States. Are you seeing any weakness there? Because prices have been pretty high for quite some time.
I think in the last year, wide swaths of the market actually have been repriced. Smaller GDP growth businesses, industrial concerns, were trading 20-30% higher a year ago than they are today, even with the recovery in January and February from the December lows. So I think some sectors have been repriced, and it takes a while for that to translate into the private markets. And I think sellers of assets, of certain kinds of assets, are going to have to realize prices have come down.
Fair to say you could use a little more volatility to make some deals here?
For sure. Volatility is the friend of a buyer of assets, yes.
And so as you look at 19, are you a net buyer or are you a net seller?
I think we'll probably sell and buy in equal increments. We have a mature portfolio of assets from our 6th fund, which are ready to be harvested, and the markets are open. So we try to be disciplined sellers as we are a buyer. The buying market right now is a little tougher because valuations are elevated, particularly for higher quality, higher growth businesses. So we have to be really selective and keep our discipline at this part of the market.
Briefly before I let you go, dry powder, it's always on the mind. $1.2 to $1.7 trillion out there industry-wide. How much do you worry about that wall of money that needs to be put to work?
I worry less about that, to be honest with you. Valuations are a function of where the public markets are trading, not the undrawn capital in private equity hands. There's always undrawn capital. So I think it's about the capital markets environment less than undrawn capital and dry powder.
And briefly, interest rates, how much do they worry you?
I mean, it could be a black swan if long-term rates were to really spike up, but I don't think that's going to happen unless there's a lot of growth in the U.S. economy.